I feel like we are approaching a very binary moment. And so I don't want investors to think that I am incredibly bearish or that I'm incredibly bullish. What I feel today is that whatever direction is next is likely to be dramatic. This is one of those moments where if what we're have seen is the low, brace yourself for a blistering rally. If this was just a pre-taste of what's to come, brace yourself for a blistering decline.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup Larsen.
A new world order is becoming clearer by the day, and in our Global Macro series, I, along with my co-host, Jem Kazan, want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world will look like. We want to explore their perspectives on a host of important issues and hopefully dig out nuances in their work through meaningful conversations. Our guest today is someone that I wanted to speak to ever since I, a few years ago, heard him talk about how confidence in central banks is linked to the level of interest rates, which I thought was such an elegant and simple way of thinking about it. He has so many fascinating insights into the world of socionomics, social mood, and human behavior that you are in for a real treat today. So please enjoy our conversation with Peter Atwater. Peter, thank you so much for joining Jem and I today for what I'm sure will be a super interesting and important conversation as part of our Global Macro series. We started this season of our Global Macro series with Dr. Ben Hunt, discussing the importance of narratives. And today we very much look forward to expanding on this and diving into the world of socionomics, social mood, human behavior, and confidence, and how that, in my opinion, is likely to set the agenda for the world and therefore for the financial markets in the coming years. Now, since this is your first time on our podcast, perhaps I could ask you to set the stage and provide a little bit of context for our conversation, maybe by just telling us a bit of your background and maybe share a few highlights that shaped your path to where you are today.
Okay. Thanks very much, Niels and Jim, for having me. I have had two careers in life. The first looks like the typical corporate finance career. Spent 13 years at JP Morgan building their asset-backed securities business. Left there to work for one of my clients and did a tour through several banks. Before, at age 45, as I was blowing out the candles, my then 6-year-old son said, "Dad, you're halfway to 90." And I decided it was time to do something different. My wife insisted that I not sign up to do anything. And I ended up, this is 2006, watching the end of the housing bubble come to fruition. And with my background in securitization, having been a bank treasurer, having worked with the rating agencies and the regulators, kind of knew what was coming. And so spent the financial crisis advising folks like you on how to work through it. I got tired of the narrative, though, at the bottom, where there was a lot of blame being laid at different people, different organizations. And at the end of the day, I was like, no, everybody was overconfident. The regulators, borrowers, lenders, just everybody. And that sent me down this rabbit hole of looking at confidence. And along the way, stumbled into work that Bob Prechter had done on socionomics, which really changed the way I looked at things, where suddenly mood as an input as opposed to an output began to reframe how I looked at it. And since then have spent, the past decade or so really getting deep inside the psychology of confidence and the psychology of decision making, and have a framework now that I use to evaluate the markets, consumer behavior, and things like that.
Yeah, no, it's absolutely fascinating. I can't wait for us to dig into some of these things. I think that it was Vladimir Lenin who once said, there are decades where nothing happens, and then there are weeks where decades happen. And it certainly feels this way when you look at the world the past couple of months. But I think we need to maybe go back a bit further and to fully understand the importance of the changes we're seeing right now. And we act as we feel, but of course, history shows that we seem to learn very little since we tend to repeat the same mistakes. So perhaps I could ask you to talk about socionomics, if we can call it that, and why this is so important to pay attention to in order to better understand what's going on right now in the world, and perhaps maybe share a few examples that helps us understand how these events are linked.
Sure. So socionomics looks at the relationship between mood and decision making, and I think people are familiar with what I would call socionomics light, which would be phenomenon like the hemline index or the skyscraper index, where there is this repetitive cycle. Hemlines go up because people feel frisky. Hemlines go down when people are in a bad mood. Tall buildings go up, and so you see different ways that confidence manifests in decision making, and that's really the field of socionomics, and they've looked at everything from economic and financial decision making, so buying things in the market, selling things, to political decision making, to cultural decision making, and what you start to see are the parallels in the behaviors. So you see in lows in confidence, highly emotional, highly impulsive behavior, financial, in the markets, in politics, in culture. And so those trends become, I think, useful indicators for investors, because on the surface you'd say, well, what do these things have to do with the markets? But we're not good at compartmentalizing our level of confidence. And so I like to see what are wealthy people doing outside of the markets. Where are they vacationing? What are they buying? What are they doing? And that gives me clues in terms of what they're likely to be exhibiting as investors.
Yeah, no, absolutely. And is it correct that there seemed to be a bit of a time lag between when we start observing things or changes in sentiment before they show up in the financial markets? So to some extent, you could say that socionomics could be viewed as a kind of a leading indicator at all, or am I off the path here?
Well, there's been some really cool work done looking at sentiment on Twitter. And what you find is that mood on Twitter, and they do all sorts of language analysis to come up with this, but basically how we feel and express ourselves on Twitter rolls into the markets on a 24 to 48 hour lag, barring exogenous events. So there's no question to me that mood is driving what happens in the markets. And so you can see the parallels even in the media. So, one of the things that I notice routinely is the media is a great mirror of mood. It's not leading, it's not following. If you're in the business of being a media company, resonance to mood is rule number one. And so I read the front page, I watch what's on television, not because I'm interested in it per se, but what are the editors of the Financial Times, the Wall Street Journal, the Economist putting on the front cover, because that's intended to resonate.
Yeah, interesting. I've got a couple of more small sort of introductory questions, and then Jim, if you would chime in a second. But you mentioned the media, and this is actually something I wanted to bring up anyways, because it plays an important role in all of this for sure. And I'm just wondering, when you look at it, how the technological revolution that we've seen in the past 20 years, including social media like Twitter, how that may have changed socionomics, if we can call it that, or how it's evolved maybe with that influence?
So I think that mood moves more quickly. It transcends society faster and broader. But I caution that that's nothing new. During the financial crisis of 2008, I read a lot of financial crisis porn. Went back and looked at one crisis after another, and I remember bookmarking somebody's comments from the crash of 1857, and you would say why, and it was a comment that unlike prior crashes, it took just days and weeks to play out. And it's sort of like, what was it? And then the author goes on to attribute it, obviously, to the telegraph. That prior crashes didn't have that means of communication. And once you see that, and then you think about radio in the 1920s, you think about television in the 1970s, suddenly you start to see that all technology does is enable mood to spread wider and faster. And it's one of the things that I think policymakers globally woefully underappreciate today. That when you put trading technology 24/7 in people's hands, the potential to close markets at a drop of a hat is especially high here.
Yeah, absolutely. One other thing I was just curious about in terms of what the impact might have been. I don't know if there was a specific impact. I don't know. But it is kind of what happened around COVID, right? The whole lockdown and working from home and all the changes we went through. And of course, there would have been some kind of impact, I'm sure, on social mood here. How do you see that? Because, again, you would think that this is something we haven't really tried before as a world society. So how does that fit into your picture?
So in a couple of ways, what's been striking to me has been the disparity of confidence between those at the top and those at the bottom in the last couple of years. And I'm the guy behind the K-shaped recovery, and it had nothing to do with economics. It had everything to do with confidence. And what I saw was that if you were able to work from home, to isolate, your confidence rebounded dramatically because of the ability to self-contain. And today we have this Downton Abbey system of delivery where, food and goods and, everything is brought to your door. So isolation has never been easier for those at the top. And so you saw their confidence skyrocket. And at the bottom, if you had to go out into a hospital, to supermarket, to deliver things, all this stuff, you just didn't recover. But the other piece of it is what we saw among young people during this period of time. And we saw really a very nihilistic response to the pandemic and manifesting in the trading world through, all the Reddit stuff that you've probably talked too much about. But that, I think, was a fascinating parallel phenomenon where you had at the very top of the market, which I put back in the beginning part of 2021, this concurrent bubble of extraordinary confidence among the financial elite paired with this fuck it mentality among those at the bottom. And that sort of swept together in things like SPACs and crypto, and it's been a very interesting time where behaviors at the top and the bottom are parallel, but for very different reasons.
I'm going to lead you into the world of finance now, because I want to just share with Peter how I got to learn about his work and why I really have been looking forward to Peter joining us today. It goes back a few years, and this was, of course, at a time where none of these dark clouds and pandemics and all of that existed. And I heard you talk about, and I think it was actually with one of a guest who's also been on the Global Macro series, Daniel Di Martini Booth, and I heard you talk about that confidence can be really seen, confidence in the Fed and other central banks, I imagine, it really relates to the level of interest rates. And I thought at the time when I heard it, wow, that's so simple, but yet so true. So I wonder, if you don't mind, if you could share with our audience what it is you've learned about that relationship, and then Jim will take us into the world of finance, no doubt.
Sure. So, lots of comments, particularly over this last decade in terms of, Tina, there's no alternative, don't fight the Fed. And all of this got me thinking about, well, how would you measure society's confidence in the Fed? And that sent me back to the late 1970s, early 1980s to say, when did people think the central banks, particularly the Fed, was pathetic, that they had no confidence? And if you go and read what was being said about central banks and the policymakers in the Eccles building, you'll see that in the late 1970s, as interest rates were spiking, confidence evaporated. There was absolutely no confidence that the Fed could turn inflation around. And it then became so obvious to me that, okay, interest rates are a reasonable proxy for our confidence in the Fed, that the higher rates go, the lower prices go of bonds, the less confidence we have. And then it became very easy to see in this cycle since then, the Greenspan cycle, the extraordinary belief of Bernanke and Yellen at these lows in confidence that, QE could solve all of the problems. Then you sort of say, okay, negative interest rates, wouldn't that be an expression of overconfidence in central bankers? And so that's the spectrum that I used. And I think it's been interesting and quite confirming to see that since I talked to Danielle, that the confidence in central bankers is waning as interest rates are rising.
Absolutely. What's on your mind this morning, Jim?
Well, socionomics is something that I think is very important sentiment. It's something that I talk about on a micro level with dealer positioning, right? People position in the markets, particularly in the options and vol space, based on their mood and based on their fears. And ultimately, that has reflexive effects on the market. We've studied this in great detail. We actually have a fund that specifically takes advantage of that. But what we've found through that positioning is that it's not directional. Like as a human base and as broadly thinking about markets, people think up and down. And the way it tends to, from our perspective, affect markets is unless you get a bad enough outcome. If people are very bearish, let's say, unless you get a bad enough outcome, it reflexively hems in the move. But if there's enough dynamism to the move, or there is enough of a real structural problem, right? I mean, at the end of the day, a nuclear bomb can go off. Like something really serious can happen that affects the world in a meaningful way. And if something bad enough happens, it actually, instead of having a reflexive effect, has a magnifying effect. And in our markets, it's really this kind of gamma effect versus kind of these Von and Charm effects. People who know me will understand what I'm talking about. I won't dive into that here. But it's important to understand that that's kind of that dynamic exists. I think that's particularly relevant now when you think about bigger cycles, right? Because we're talking about, populism that's been building over the last really decade, right? I mean, it's hard to believe we had the Tea Party and fiscal conservatism just a decade or so ago. That populism has built, right, as a function of the monetary policy and supply side economics, et cetera, that we've seen, and the inequality that's been driven by the Federal Reserve. And so I'm curious, people are very bearish right now. It's pretty obvious, right? We're in the 4th percentile now of mood, of positioning and sentiment and lots of different metrics. I fear, and a lot of people are fading that, right? Reflexively saying, okay, well, this can't get worse. Like we have to bounce back. But again, sometimes that can become reflexive. To your earlier point, the market was rallying and there was this nihilistic populism being expressed by crypto, right? I completely agree with that. What happens when that nihilism gets expressed now to the downside, right? At the same time, things are actually breaking. And so do you have a mental model for socionomics socionomics as it relates to that. Yes, there's a reflexivity to it. I think that's people's initial reaction, right? When people get too bearish, be bullish, or when people get too bullish, be bearish. But I think there's more to it than that. I'm curious to hear your thoughts.
Yeah, so I've probably been frustrating to my clients since the last couple of weeks, maybe even months at this point, at my relative indifference between the bull case and the bear case. Because to your point, mood is really dour, and yet we haven't seen any sort of a capitulatory event. What I sense is fatigue. What I sense is sort of the family car ride that's gone on too long, and the kids in the back seat have had enough and want to get out. And there are some who would say, well, that's enough to create a low. And it's like, yeah, I could come up with, and did for my clients, the bull case, that there are plenty of indicators would say this is the low. And the analogy I used was October 2011, where you'd risen out of the financial crisis and then had a setback. People thought it was going to get much worse. You had the famous economist cover with "Be Afraid" with the vortex on it. Lots of good socionomic indicators saying this is the low. And we could have just had that what we're experiencing is this setback from the bounce up from COVID. This is the relapse, and we go, we land solidly and take off, and you can create a really bullish case, particularly for places like Hong Kong and all of the, the carnage, the long duration equities, the dream bubble that has largely popped. The challenge that I have with that is what I think of as stacked vulnerabilities that people are experiencing today, that the hits just keep coming. And, if I think about the weight that particularly the low-end consumer has today, housing, gas, food, we have a war in the Ukraine, we have scarcity, we have now school shootings. There's a burden to that. And that burden runs the potential of creating exhaustion, that it collapses on its own mood-driven weight, that what today is described as uncertainty, as powerlessness, falls into despair and hopelessness. And that's a game changer. That's a game changer because institutions are highly abstract organizations in a time where me here now reality is driving decision making. And so you don't have the influence from a societal perspective on what's happening in the streets.
Yeah, I think there's a big mean reverting effect in the short term, right, to sentiment, or even the midterm. There is a momentum effect, though, when you start looking out longer. And let me get to what I mean here. Populism, I think we both agree, and I think it's pretty obvious. Trump or whether you're looking at Trump or Bernie Sanders in the U.S., both have gone left, right? Globally, populism has become a thing, and that's a function of inequality that's been building. COVID released kind of the hounds, right? It allowed that 12 trillion in fiscal policy, which is a populist revolution by any other name, happen. But if you look at crypto, for example, you've had this distrust of government by the labor class, which is the younger generation. You've had this belief in technology's ability to solve all these problems, which has been driven by unlimited monetary policy and chasing dreams. So crypto has perpetuated kind of the market bull. But as it turns, it kind of it vanishes, right? It liquidates. You're going to get a bit of the opposite. Also, populism drives fiscal policy, which drives inflation, right? Inflation drives populism more, right? And at the end of the day, more populism means more price controls and fiscal policy in some way, which at the end of the day reduces liquidity. So these are some of the momentum factors, right, to sentiment that I think that sometimes are underappreciated. And I think really, could actually, and I think the populism one in particular, once it gets going, much like you had a positive feedback loop to monetary policy and free market economics, you have a negative feedback to a rebalancing that happens to equality. So I think that's an interesting, important point to kind of socionomics. I think it's incredibly important. But at the end of the day, how does it affect supply and demand? And there's multiple different factors, which I think are interesting. Do you think on the crypto side, going back to crypto, that as, I know your views are that it's likely to see another leg down, right? And that will cause a lot of anger. Do you feel that if that happens, that will, how do you think that anger will be channeled? What do you think it will lead to ultimately? I'm curious.
Yeah, so I think that crypto runs the risk of being an enormous betrayal. And that it becomes a triggering point for the eye-opening to a cycle of what I call griftization that has occurred since the banking crisis. That what we've seen is the financialization of self-promotion like never before. And it has appealed to the very high end when you look at folks like, Elizabeth Holmes and Theranos. And it's been overwhelming at the low end, politically, financially. There are lots of parallels in the cultish figures and cultish behavior that we see. And I know people will take offense to my use of the word, but I mean it in its true dictionary definition in terms of blind and eager followership in fantastical promotion. And here it's a precarious thread that gets pulled because it's in so many things. And I think especially for young people who had nothing to lose, invested it, and to lose it again is going to be where you see dramatic change. Youth in revolution is a common pairing. And this brings in issues of relative wealth inequality, age and all sorts of demographics. And I think what those on the left and the right are so overlooking is that the real battle isn't political ideology left and right. It's more up and down. And how does that divide become resolved? What happens between those at the top and those at the bottom in power, in money, in all of these different measures that I look at? And that's what I think we have yet to see unfold. Could that, on the other hand, Jim, result in a enormous wave of money into cryptocurrency? Absolutely. The question in my mind is, what in that environment does the crowd decide has value? People, if you look in a prison environment, ramen noodles have an extraordinary value that is underappreciated elsewhere. But we will pick something or some things that we believe matter most to us. And that's where, economic value will be moved.
Yeah, I think I couldn't agree with you more. You're going to hear this a lot. I'm going to try and disagree with you more, but I think I agree with you on a lot of things here. That inequality is the real issue here, the populism. And we've seen this, big cycles. This is what drives big cycles, right? In natural selection and free market economics, inequality is a natural state of things. But we as humans believe in equality and justice and all these things, which are not natural constructs necessarily, that when exerted upon this natural system create big booms and busts. And that's what populism is. That's what revolution is. And it generally, to your point, feeds into the young, because the young are the labor class during the boom and they don't have the assets and they don't benefit on the way up. And they're also young and emotional, right? And they have the energy to fight. So that tends to be the case. And I agree that's what we're seeing. Crypto was a clue, right? Crypto was that zeitgeist embodied in markets. It was a desire to catch up. It was also for this generation, again, believing in technology's ability to solve all the problems because that's what came. It makes tons of sense. And I fear you're right that when crypto does, or if it does ultimately have a washout, it will only feed in to that lack of hope that is left. I'm curious where that channels, right? That revolutionary impulse seems to be, if you think about crypto, focused on money, on monetary, right? And I wonder, I mean, I don't think it's a coincidence that the Fed, under the shade of darkness, built barbed wire fences around itself in the last month and a half. It hasn't been publicized, but I think there's this fear of credibility at the Fed. And I think I don't think enough people talk about what that might mean ultimately for America and for broadly overall. So I'll shut up for a second, but I'm curious to hear your thoughts.
I want to add to that to that discussion a little bit, because I think one of the things that has changed to some degree. I mean, we can get upset if we lose money, right? Prices go down, but I think what's changed for me, at least to some extent, is what we saw with Luna. Because suddenly it brought out some real anger. I mean, if you look at some of the Twitter feeds from people I think we all know who are well on all these platforms and so on and so forth, and who have been encouraging, let's say, the crypto world. Some, of course, have been, outright pumping it, I'm sure, but others have just been very much focused on it. The anger towards these kind of rock stars, really, really interesting to see how the tone has changed. And I also wonder if there is, and I think you've talked about this, Peter, at some point, that there might also actually be a risk to the people at the top. So we think about the people at the bottom struggling through all of this, but what about the people at the top who may have borrowed money against assets that may not be worth what they were, and so I'd like to bring that into this crypto segment if we can.
Sure. So one of the unseen bubbles to me in all of this is the level of borrowing those at the top have undertaken since 2009. And I've said this before, but a bank like J.P. Morgan has more outstanding in its private bank than it does to its entire credit card portfolio.
Wow.
And that was, just a staggering acceleration of one while the other has remained largely flat. And so behind the scenes of all of this, we've seen a growth of leverage to those who have been presumed to be invulnerable. They have felt that way. Their lenders, the entire entourage, the luxury goods industry. I look at the dedication of resources in the past 12 years to catering to the very high end in all of its many wants is just absolutely mind-boggling to me. And so those at the top, I think, are vulnerable in experiencing a bubble burst that they and their entourage are woefully unprepared for. And there will be no sympathy. There will be no, this is not going to be 2008 again. The crowd will be celebrating the failure of those at the top. And so that's part of this closing of the gap. And one of the things that I would encourage you to think about is we talk about confidence, but the opposite of confidence is vulnerability. That confidence, I have certainty and control. When I am vulnerable, I have uncertainty and powerlessness. And what this huge divide has highlighted is that others have these two feelings of certainty and control that I at the bottom do not have. And when we talk about closing these divides, what we're really talking about is those at the bottom want to regain certainty and control in their lives and will take pleasure in contributing to the powerlessness and uncertainty of those who have had such extreme certainty and control in their lives.
I think this is a good tie-in to your K-shaped recovery, right? I think we've had K-shaped recoveries for quite some time, where people are diverging. I know you called for one in 2020, and to a great extent early on we had one. Obviously, the fiscal response has kind of, I'm going to argue, made an X recovery, got them going the other direction, right? And I think we've had so many K-shaped recoveries over the years because the Fed has been the only game in town, because monetary policy, by definition, is sending money to those who can borrow, which is the top. And so to the extent that fiscal policy or responses to people is the new mode of dealing with inequality, essentially, are we going to see X type recoveries going forward every time the market or the economy crushes? Do we start to see pushes towards addressing inequality?
So I've joked many times that the significance of the K-shaped recovery was the resonance of the term. And I think it speaks to your point that we've had one after another, and that it's such a clear phenomenon this time that maybe it's one too many. And I think many are overestimating the ability to counter what could be ahead with additional fiscal stimulus. That the advent of modern monetary policy as a theory, as a concept, I think was itself a consequence of zero negative interest rates. It's something that's only believable in an environment where money is free. And I say that not as a criticism of the individuals, but just let's talk about it. Why was it resonant? And resonance is only enabled because people believed in that environment that money was free. As money goes up in cost, responding with fiscal stimulus becomes more difficult. Now it becomes a question of choice. So I think, one of the obvious choices would be greater taxation as a means to help fund whatever economic malaise we're experiencing. But I wouldn't count on governments as being in a position to solve this with either monetary or fiscal stimulus. I think we've seen the peak of the ability to do those, behind us. And I would also say that given the inflation that we're experiencing today, policymakers will be far more reticent to over-respond to the next crisis. That they are going to be naturally more timid.
You mentioned the word inflation, Peter, and today at our time of recording, it's only been an hour or so since the latest inflation data came out. I'm looking at a headline saying that U.S. inflation quickens to 40-year high. So I kind of want to talk about that a little bit, but I want to talk about inflation in a slightly different way because sometimes I think we just talk about the word inflation, but really there are probably two kinds of inflation. There is this kind of expected inflation, something we can build on, something we can rely on, something we can plan after. And then there's this unexpected inflation, which is probably what we see now because nobody was really expecting this level of inflation. And by the way, unexpected inflation means that it can also go down a lot from time to time and then goes back up again. So it's probably more the kind of the 70s type inflation. And I was curious to know, because I think the unexpected inflation is much worse, I think, than expected inflation. And I'm really curious to know whether this is something you've have thought about, the difference in inflation, because not a lot of people talk about these differences between these two types of inflation, and so that how that might tie into the whole thing about confidence, I imagine, as well.
Yeah, so I don't think of inflation as an economic phenomenon as much as a psychological one. And there it ties to feelings of scarcity. So what inflation creates for me, particularly as a low-end consumer, is enormous feelings of vulnerability because things are now scarce. I can't afford them. And so I have to start to make choices, and those choices cognitively are difficult. And so in my classes, we talk a lot about poverty not as a economic condition, but as a psychological one. And that's what we're seeing. I think the stress cognitively, emotionally that goes along with these issues, because to your point, the wildly swinging inflation destroys predictability. And again, certainty is, one of two legs that I need to stand on to be confident. We don't like environments of control but no certainty. It feels like Las Vegas to us. And so we need to have a better sense of certainty. Now, having said that, what's so interesting about today's phenomenon is we have this huge connection between markets, economic inputs, gas, food, and the economy. And I call it, we live in a mark-to-market economy where investors can now speculate in all of the things that you and I need to live on in our real lives. And so what I think that creates is an environment of huge spikes up and down, which have the potential, particularly right now, to create a complete miss where everybody is expecting prices to remain high, and we see them violently collapse unexpectedly. And I there's a headline quote from Janet Yellen this morning. Gas prices are going to be high forever. Something like that. And those the way she said it caught my attention because it's just an extrapolation. And I think what we're likely to see is sort of the lumber phenomenon moving through product after product after product, that investors, the zeitgeist moves it too fast in one direction only to move it too fast in the other. And I'd be curious, Jim, you're nodding your head up and down, so I want to get your thoughts on that.
Yeah, no, I think this is incredibly important, right? It is the cost of money, and the cost of money feeds directly into supply and demand. And I think it's easy I think socionomics and psychology are all critical to understanding a part of supply and demand. But I'm very mathematical in nature. I think about derivatives, and I'm always measuring. We're actually measuring real time supply and demand and factors that relate to that. So there is a real structural supply and demand factor to interest rates going up, and just in terms of money in the system and money in pockets. I will take exception, and this is somewhat to be polemical, but I think it's important, with the idea that volatility and expectations of interest rates is bad. I actually would say that right now, what the Fed wants least of all, and the most dangerous thing for this market, is expectations of higher inflation that people have more confidence in. I think that is, long-term inflation expectations are the worst possible thing for the system right now. And the Fed knows it. That's why, by the way, people are like, the Fed's an idiot. How could they think this was transitory? I didn't think it was transitory. They were simply trying to tell the world that, please believe it's transitory, because if you believe it, at least long-term interest rates will come down. So the reality is, and we know this broadly, that, long-term inflation expectations beget more inflation because two reasons. One, people bring investment forward. They start building inventories. They start buying things now because the cost will be higher later. A, and B, if inflation is 6%, expectations are that it'll be 6% for the next 2-3 years, and interest rates are 3%. What's everybody going to do? Everybody's going to go borrow at 3%, anything that's pinned down, leverage it 4-to-1, and buy more of it, which pushes inflation higher. So the whole system is this momentum factor. If long-term expectations for inflation go higher, the whole thing begets more and more and more inflation. So I think the Fed is actually trying to create volatility and expectations for interest rates. Actually, I think any confidence that inflation is going to be here is quite possibly the worst thing that can happen to the system. So I'm just going to push back on that a little bit, and curious to hear your thoughts.
No, I agree with you. I think the Fed is determined to push the markets into a corner. And if they just have to keep raising the Fed funds rate to do that, they will do that. No, I agree with you. And the job market gives them latitude, more latitude than I think people appreciate. But I think we need to recognize that they're going to push it and keep pushing it and keep pushing it. And the breaking point on the other side of it is, to your point, Dan, about deleveraging all of those inflation expectations.
And at the end of the day, how do they do that with the tool that they have? I think, they don't have the right tools, really. They have to take money out from corporations and much like monetary policy was actually deflationary for all these years, we somehow believe that by pulling away monetary policy, we can also create a deflationary environment, which, they can eventually if they just take all the money away, drop a bomb on the whole economy. But it's really the wrong tool for the job. So I think that's the existential problem that we're facing right now.
Speaking of equity markets, and I don't know whether this is something actually that you do agree with or follow, but I heard you earlier talk about Bob Prechter, and of course a lot of people will know him as the longest running publication on Elliott Wave, but of course they also, as you referenced, he has spent a lot of time on socionomics for sure. And so I don't know whether you see any links in what you see in terms of the social mood and changes to social mood and what they're expecting in terms of markets where they have been, and I will say that because I've been following them for a while, that they don't always get it right, but they are looking at this, the largest cycle top that you can have within Elliott Wave terms. I think they call it a grand super cycle high or turning point, but it is a high turning point this time. And then essentially something that could, in their view, end up being a bear market in equities like we saw in 1929. So I'm just curious whether you, in your work, actually also look at these things and try and tie them together in terms of where markets might go, because clearly if they're right, this will have a major effect on the world economy.
Yeah, so I do read Bob's work and the work of his team and have a huge amount of respect for it. I am not an Elliottician, and so I don't spend a lot of time focused on wave counts and the like. What I'm looking for in my work is indicators of extremes in sentiment. And here I would say that we saw an extraordinary extreme a year ago, January, that, whether you look at SPACs or crypto, what you saw was a bubble in abstraction, things that were fantastical with enormous, time horizons and valuations to go along with it. I think the term long duration equity understates the magnitude of the abstraction, and then the valuation we put on those abstractions. The challenge as we speak today is, if you look at a lot of those abstractions, they've been beaten with a stick. They have been absolutely pummeled at a time when the bigger, stronger major indices have gone into a bear market, maybe-ish, but behind the curtain, there's a lot of carnage. And so the question for me is that carnage likely to rebound? Could it rebound? Could you see, not that this past January was the top, but now some sort of a hyperbolic price ascent? The danger in calling the tops of the bubbles is they have this wild way of coming back from the dead. And having talked about Tesla in 2019, and felt the sentiment then, I was like, look, everybody expects him to go bankrupt. Be careful what you're wishing for. And we've seen, the resurrection of what happens when you have carnage and dreams come back to life. And so I think you can make a case, albeit I think it's a hyperinflationary asset bubble case, that you could have another another wild and crazy upward cycle. And so here, the question is this 2006 going into 2007, where what we've seen is the LIFO unwinding of a bubble, that the last in wild and craziest stuff has unwound first, and eventually what you get to are the too big to fail enterprises, aka big tech. So this is one of those where if we start to see big tech drag and become vulnerable, then this is a repeat of what we've just seen in a broader collapse of technological dreams that does incorporate and pick up the biggest of the big. And there that has enormous ramifications to the passive investor because they are so overweighted in big tech.
Yeah, absolutely. And to your point, actually, Peter, when we spoke with your friend Grant Williams a couple of weeks ago, we actually talked about the fact that one of his other friends who actually lives here in Zug, Felix Zulauf, had exactly forecasted kind of what you referred to there, that we would see like a 30% correction this year, but that it would end up being a time where you actually would see a doubling of equity markets into 2024, and then everything falls apart. So he sees exactly what you described there. I have no idea what's going to happen, but it is interesting that we can't be sure exactly how this is going to play out, which makes it a very interesting, but certainly also a very difficult time to be an investor. Another thing I wanted to ask you about is also relating to one of our previous guests, Peter Zayan, who talks very clearly about this trend towards deglobalization that we're heading into. And I'm curious, now we've had 50 or even 70 years of globalization, and what describes that or is stability and peace and all of those things. If he's right, that's a major shift if we're going towards deglobalization. So if he is right, how do you see that impact the whole thing about confidence? It could be in different countries, it could be in different currencies. Everything seems to be up for grabs if we're heading into a deglobalized world.
Yeah, so I'd look at globalization as a consequence of rising confidence. In the parallel, it's a concept I call horizon preference. When we are under threat, the bear is outside of the tent. The only thing that matters is me here now. Myself, this immediate time horizon, this immediate physical horizon. Those are the only things that I care about. As my confidence rises, all three of those broaden. And at the extreme, we embrace something that I call us everywhere forever. We're collegial, we're consensus building, we're peaceful, we are the world embracing of things that are abstract and different, and not just the people, but the places, the geography. This huge accordion opens in terms of relationships, in terms of time horizons and geographic horizons. And I think you can make a case that we're somewhere near a top of it. You've got people exploring Mars. You've got, all sorts of interconnectivity. You could say Tom Friedman called the top with his book, The World is Flat. So the consequence of that is, to me, deglobalization will be a consequence of falling mood. We naturally balkanize. We naturally divide. We move from way outside in this abstract circle to the middle of the circle being all about me. And that, again, has huge implications for the World Health Organization, the UN, NATO. These supra-international bodies become too abstract and irrelevant because the crisis I feel is right here. And I think we got a bit of a preview of that with COVID, if confidence falls.
Right. So that's quite interesting because, sorry to interrupt you here, because I want to try and really understand that, because what you're saying is that deglobalization is a consequence of change in social mood. So what I'm curious to understand is, okay, so what if everything is going great? What is it that starts to change the social mood that leads to the deglobalization? Now, I can understand a pandemic can do that for sure, but is there anything else that you've seen that causes the change in mood before we head towards all the other consequences? That I want to understand a bit better.
Yeah, so the biggest cause of all of this, I always say, is the overconfidence that precedes it. We have a hard time identifying what is the tipping point. What's the thing that
Right.
sets it in motion? If I go back and I look at the confidence charts around the collapse of the banking system, what you'll see is that economic confidence bottomed the weekend Lehman Brothers collapsed. And so to say that Lehman caused confidence to then rise is just a very uncomfortable statement. But if you're looking for causation, that is true. I would say that what Lehman marked was the hopelessness and despair that goes along with bottoms. And so the question to try and answer yours is, at peaks, there's rarely a single moment where you can say, this was where we were most overconfident. I feel that, with the markets, maybe I can put that around January 2021, but the unwind will begin on its own. Look at what just happened kind of a thing. It's a very subtle deterioration in mood.
I'm going to jump in here. I think I couldn't agree with you more. It's a deviation from equilibrium, right? The further you get away from some equilibrium, and this is why cycles happen, the more fragility there is. Doesn't mean that moment things are going to break. In this cycle, it's been inequality, right? It's been monetary policy driving. And I would argue, by the way, to your globalization question, Neil, is we got globalization massively for 40 years because corporations were given more and more money. And what is a corporation intended to do? Increase profits. And in order to increase profits, they got to lower costs, right? And so there's this massive push that's been happening. And it's a cooperation game at the top, right? And we've been in this massive cooperation game where everything works. But inequality was the result of all of that, right? And the populism that came, because again, we got away from this equilibrium, is ultimately what has, pricked that bubble. It's what brought, again, Trump left and brought fiscal policy, and now is in the process of going the other way. Populism is correlated with nationalism. It's correlated with competition over commodities and scarce resources because the prices are going up. And that's also ties into the geopolitical stuff with Russia and China, Russia and Ukraine and China support. All of this is connected, but it essentially at its core, to Peter's point, is a move away from an equilibrium to a far enough point where fragility presents itself. And I think that's the important point. I couldn't agree with you more, Peter.
Yeah, we're naturally xenophobic when confidence is low.
Absolutely. Absolutely.
One other thing that puzzles me a little bit that I'd love your thoughts on, Peter, and that is, we talked about technology earlier and how that have had an impact on the media side, right? But it's also had an impact on how we spend money. We don't buy things anymore. We subscribe to things. We lease things. It completely changed. And I imagine that, especially with inflation coming in, that changes things for the consumer because now they have to decide on other things, so to speak. What subscription don't I need anymore, or whatever it is. How does that play into your work? That kind of change in our behavior, I guess it is.
So I would put subscriptions in a broader bucket of the me here now phenomenon in the economy. So whether it's the iPhone, Keurig, TikTok, Twitter, everything has been oriented around me here now, satisfying our me here now need. So subscriptions are just another wave of it. And here I think it's worth highlighting for older listeners. This Polaroid capitalized on the same phenomenon in the 1970s. This is the first time we've seen this sort of me here now monetization. That And you see it in Airbnb and Uber and all of this me here now utilization of assets. The challenge is that for the consumer, they have the ability to throw everything overboard this afternoon. I can cancel it all. And so you have a time horizon mismatch between consumer preferences and the support system that provides it. Because you've got long-term capital and long-term debt and long-term, commitments that are enabling all of us to live this me here now elective lifestyle. And it feels oddly like the mismatch I've lived through as a bank treasurer between short-term and long-term rates, the mismatch that you've seen in the commodity markets between long-term take-or-pay contracts and volatile markets. I don't think that this mismatch ends easily. And inflation will put more pressure on terms of what did we just throw overboard. And interestingly, and I don't mean to belabor my point, you're seeing organizations like Netflix in response trying to be more rigorous in their passwords. And that's only going to piss people off more. You enabled me to do it for free, and now I've got to pay full price at a time when I'm already frustrated and angry. Yeah, I'm out of here. Screw you.
Yeah. No, very interesting. Speaking of themes like that, I'm curious, have you studied from an investment point of view? I mean, we all know that certain strategies have worked really well in the past decade or two, like, say, private equity and stuff like that, where you could kind of set your own valuation when you feel like it. But have you studied in terms of what investment themes might actually work well when social mood changes to the downside? Because many of us have never really experienced that.
So if you think of bear markets as being a retreat from abstraction, well, the two things that immediately come to mind are cash and commodities, because we refer to them as real assets. And we know at lows and very lows in markets, people want physical cash stuffed in their mattresses. At the lows in 2009, people were advertising mattresses with built-in safes. So if you think about it as far as a retreat from abstraction, you go from long duration equities to value to sort of the pilgrimage to owning stuff that's real. And the question becomes, what do we ascribe value to in those moments? And here, if reality becomes based on physical goods, grains, energy inputs, that has not just massive geopolitical implications globally, but staggering implications for the United States, because the entire supply of both of those is largely concentrated in the center of the country, and you have more than half the population on the coasts.
I think that's an incredibly important point. I actually had that as something I wanted to ask you about. I think that's very insightful. A lot of people haven't thought about that. Peter Zeihan, who was on here earlier, made the point that America, right, is an incredible place of strength, right, in a troublesome sea. That this crisis that's coming might end up being the best thing that happened to America, because it is the place that is, and to reinforce his points, we have, commodities, all the commodities we need, and then some, both in terms of energy and food supplies. We're an island, right, that's has the biggest military in the world and the intellectual capital, et cetera. So our threats are not likely to come from abroad, right? They're likely to come from within. And to your point, I think this is a thing that people are missing, is that the strength of commodities are actually going to support a part of America, right? They're going to elevate its strengths at a time of already, increasing tumult. It's really going to drive the strength of cities down a bit relative to maybe the internal part of America. This is something I hadn't really thought about. And I'm wondering if you think that somehow creates more existential risks to the political system here in the U.S. I'd love to hear your thoughts.
So it's a matter of degree. The analogy I've used a lot is we may be the best house in a bad neighborhood, but mom and dad are getting divorced. And so, you have to look inside the house as well as, outside the house. And so I think that there is a time period where absolutely the United States, the dollar, there are lots of things that we benefit from. But if survivorship becomes the issue, then what's happening inside the house begins to really matter. And there, I think that you have some interesting broader implications, in terms of how does this ultimately resolve in terms of the internal workings of the United States. And the one thing I remind people of is, please don't forget that the highest organization in the United States in terms of institutional confidence today is the US military. And again, if the left and right are fighting with each other and you're trying to run a military, a national military, that's a real problem. And I think people have oversimplified the divide in the United States. And what we know in environments of balkanization is that the alignments don't necessarily end up with where people thought they started.
Speaking of the divide, and I don't want to put you too much on the spot here, Peter, but I can't resist because I'm the only, well, I guess, Jim, you have some European blood in you, but since I'm the only one located in Europe, I'm curious whether you've thought about, after all of this decades of increasing confidence and all of these institutions that we have seen rise as a consequence, not least the EU and the euro, do you think that we might actually head into a confidence crisis that is big enough to break up that union and even the currency?
Yeah, so, again, the question would be, was what we saw in the Greek crisis, the prior crisis, was that a low, or was that an indicator of what is ahead? Was that a warning of potential vulnerability? And I thought it was interesting, the term fragmentation suddenly was all over my Twitter feed this morning, which is not a term we've heard a lot. And so people are paying attention. And in that regard, I'd watch Turkey. Turkey, to me, is the oversized canary in the coal mine of a national crisis. It has been waning for some time, and what happens there, I think, has real relevance, not only for Europe but for NATO more broadly. And here, this is where national self-interest, particularly as it relates to food and energy, is likely to become a populist topic, as Jim throws out, that has nations competing with each other in terms of supply. So what we know is that the more confidence falls, the further we come apart. And so can Europe come apart? Absolutely. But it will be a function of what happens to mood between now and then. To me, it's not preordained. None of this is preordained. It's how low does mood go.
I think your point about Turkey is very interesting. Obviously I'm Turkish, so I have a little bit of interest there. Turkey's always been the border between East and West, not just geographically, but culturally and lots of other. And it's really been tied to the West in recent, history. In times of geopolitical stress, it tends to become unmoored, and that's because if you think about it, it has a benefit to be unmoored because it can play both sides and it can become in the middle. And I think that's what we're seeing. I think we've seen it for about 10, 15 years, slowly happening. And I think it's accelerating. Turkey is no longer, yes, it's part of NATO. Yes, it's, for a while it was trying to be a part of the EU. It was trying to be completely internalized. And then that not happening, now I think it is really, really going to play this middle ground, which creates more drama between East and West because it no longer has this Western bloc. And I think it's very important in that regard. And I think it is a critical place to watch in terms of the shifting tides of power and risks in the market.
Can I add one other sort of related point? And this has to do with Russia. One of the things that is so interesting about Mr. Putin is that normally when confidence rises, we become generous, we become kind, more peaceful. There is a personality type that becomes more vindictive, that uses those feelings of invincibility to seek revenge. And so one of the things we know, looking at Russia over long periods of time, that one of the best measures of sentiment for Russian leadership is the price of oil. And so I think we need to watch oil, because the higher oil prices go, the more aggressive I think we're likely to see Russia become in many aspects. I don't think it's insignificant that we had a lot of Peter the Great references in this past couple of weeks. And again, the further oil prices rise, the more empowered Mr. Putin is likely to feel.
I think it's not necessarily a personality type. I think Russia and China are both hemmed in and have existential fears in the context of aspirations of greatness. And I think that's a human trait. When you feel at risk and you feel like there's no way out, you lash out. And I think, there's a demographic problem in both countries, that they look forward and see themselves hemmed in at this point of extreme strength in the West over all this time. And they look forward and they see great risk. So their windows are closing in a sense, and they have to act. So, but I agree with you in the context of that bigger picture, having the strength to keep swinging, getting the strength that will only make it worse.
I was just going to comment on the oil price, and given the fact that I think have a pretty good idea that OPEC Plus is pretty much at capacity in terms of pumping more oil. I fear that Putin seems to be getting stronger, not weaker, and so with the oil price. I only have a couple of questions left, Peter. We've taken a lot of your time. We really appreciate that. And we obviously a lot of our listeners are investors themselves, and it's kind of interesting. Even though I heard you earlier, Jim, say that it feels like a bear market, et cetera, et cetera. But actually, to me, it doesn't feel so much of a bear market compared to other periods so far. And obviously, I shouldn't wander into the world of the VIX at all in this company. But I will say also that the VIX seems to be not necessarily spiking as much as you would think. But anyway, what I was going to ask you, Peter, is there any ideas or suggestions you can share with our audience as to how you can implement a more confidence-driven decision-making? And I know this is not for day trading or anything like that, but just more how you think about investing from your perspective.
Yeah, so if I look at decision-making that's made in an environment of control but no certainty, which is what investing decision-making is. What happens is that most investors buy or sell based on the outcome that they imagine. And I deliberately use the word imagine because anytime we're talking about the future, we are imagining. And I think it offends a lot of people, but it's like, no, let's, if you're talking about the future, rule number one is remember that you're imagining. And the second aspect of that is remember, too, that your imagination is a function of your own level of confidence. And so if I'm confident, the future that I imagine is likely to be much brighter than the future that I imagine when I'm not confident. And so the degree to which you are certain of the outcome is expressing not the probabilities of that outcome, but your own level of confidence. If I'm capitulating and selling at the lows, what you're doing is expressing that you believe nothing can go right and that the outcome is only going to be disastrous from here. And conversely, you're buying at the top, you're buying short-dated call options at the top because you believe the outcome is, of course, only going to make me money. And I encourage investors to be far more ambivalent about the outcome they imagine. And that before you trade, before you buy, consider the absolute opposite scenario. And to appreciate that the less you can consider it, the less you're willing to believe it can happen, the more likely it is to happen, because your belief system is too strong in a world of imagined outcomes.
Interesting. Peter, there were so many things we could have asked you about. You cover such a broad spectrum of very, very interesting and topical areas. So I just wanted to ask at the very end here, what did we miss? Is there anything you want to kind of bring in towards the end here that we forgot to bring up in our conversation?
Yeah, I would just say, Niels and Jim, that we're talking here today on June 10th. And I want to be clear to your audience that I feel like we are approaching a very binary moment. And so I don't want investors to think that I am incredibly bearish or that I'm incredibly bullish. What I feel today is that whatever direction is next is likely to be dramatic. This is one of those moments where if what we're have seen is the low, brace yourself for a blistering rally. If this was just a pre-taste of what's to come, brace yourself for a blistering decline. It's one of those times, and I go through this with my clients, from time to time, where the setup is too unclear to take a stake, because the price of taking a stake and being wrong is going to be dramatic. It's going to be jaw-dropping of, man, I wished I didn't do that.
Well, it's a great place to end our conversation today, because I think it opens up for us to have you back later in the year or next year to talk about whether we did get a massive, dramatic move up or down, for sure. But Peter, thank you so much for spending time with us today. We really do appreciate it, as I'm sure all our listeners do. And by the way, make sure you get a copy of Peter's book and follow Peter's Twitter feed, which, by the way, is fantastic. And you can find links in the show notes, of course, because as you can tell from today's conversation, we are living in a truly global macro-driven world, and it is perhaps more important than ever before to stay well informed. From Jem and me, thanks so much for listening. We look forward to being back with you as we continue our Global Macro series. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.